Welcome to the GloryHouse Podcast series. My name is Jason Kwong, a partner of GloryHouse Wealth Management. And today it's a pleasure to have Phil Cummins with us, Managing Director of StepStone Group. Welcome, Phil.
Thank you very much, Jason. It's great to be here.
Yep. So just to start off, can you introduce StepStone Group, who you guys are, what you guys do, and how you guys differentiated from other fund managers that play in the VC and private equity space out there?
Great. StepStone is itself a large, publicly listed private market specialist. We cover multiple asset classes, and I'm part of a venture growth team. And if we think about venture growth and what we do with that part of the world, we are one of the largest dedicated venture teams within the private markets. Today, we're managing about $26 billion in assets. We've been in existence since 2000. We invest across funds, direct investments into companies, as well as one of the largest secondary players today. And we do that both across discretionary capital, as well as working directly with our clients on separate accounts.
So StepStone has a very diverse portfolio across different GPs, industry, and subsectors. What are the main investment themes that identify in this fund?
At a high level, we are investors in the innovation economy. And as we think about venture capital is primarily around technology investment, whether that be directly in terms of things like software today, AI. If you break that down, we cover consumer, B2B software, cybersecurity, today much more in the deep tech range. And so sort of a core technology investor at the heart of what we do, also covering areas is like healthcare as well.
So let's talk about the AI and tech opportunities in your portfolio. Where are you seeing the most compelling opportunities in this space right now? Is it the infrastructure, the AI adopters? What's most fascinated you in this space right now?
I think as we think about the AI opportunity, and if you look at sort of flow of dollars today from a US perspective, today the majority of dollars being deployed into companies at the venture capital level is majority into AI. And I think when we look at what we're doing and how we're investing, given the breadth of our platform, we're really investing across the whole AI stack. And I think as we think about the technology shift that we're in, AI has reinvented the whole technology stack. And so we are investing, across all the way from the application layer to LLMs, the infrastructure layer that's supporting that, things like chips, power, data centers. We're very excited for that opportunity that is presenting itself right across that. And I think as we think about that, where is that opportunity going to go? I think we're still very early in that phase. And this is sort of what we're seeing is quite different to what we saw in the build out of the SaaS era. So today, this really has been a CapEx-led investment cycle. And there's sort of lots of themes that we can talk about, but I think, the ultimate value creation and the companies that are going to be created that are going to cater to the market opportunity is quite extensive. So today we've sort of invested across all of that, but I think if we think about the application layer, that's probably an area where you're going to see a lot more investment over the next 3 to 5 years.
So SpaceX and Anduril are some of the most anticipated names for a potential IPO in 2026. Can you talk about these two companies and how they form part of your asset allocation in the portfolio?
Yeah, we love both of those companies. And, they're two companies which I think have come very much into the mainstream over the last 12 months or so, and nearly sort of household names to some respect. As part of our platform, I think they are very significant investments across a sort of a number of our funds, and they're companies which, while I think they've come into sort of the investment sort of mindset and the popular media in the last little while, they're companies that we've known and tracked for a long time. Both of those companies have been backed by some of our sort of core partners on our platform, groups like Founders Fund, A16, and Andreessen Horowitz. And if you look at SpaceX, Founders Fund made sort of back around about 2000, 2008. And so it's a company we've been tracking and known for quite some time. we're very excited. They've talked in the media about plans to go public at some point. So they are a couple of sort of the really anticipated IPOs. And if we sort of think about the IPO market over the last few years, last year we did see a number of very interesting IPOs, venture-backed IPOs, probably not as much as what people were anticipating. A few years before that was a very, very dry period. And if companies like SpaceX and Anduril do go to the public markets in the next 12 to 18 months, it's going to be a pretty significant event in terms of the quantity and potential liquidity that's ultimately going to come back to the ecosystem over the next little while.
Yeah, so with a substantial amount of undeployed capital dry powder in the market right now, how do you see the US IPO market evolve over the next couple of years? And what does that look like for the exit timeframe strategies for companies in your portfolio?
Yeah. So the IPO market has been challenging. We did see a number of great IPOs last year. I think the anticipation is that we will see more IPOs in 2026. I think what's interesting about that, if you sort of look at some of these companies that are talking about coming to the market, today these are very, very large companies. We're sort of in the tens of billions, if not the hundreds of billions of dollars of market cap, potentially $1 trillion where, people have talked about. So these are very, very significant large companies. I think one of the things that we talk about a lot within venture capital is power law. And power law demonstrates itself in sort of a number of ways. But I think, when we see, the IPOs that we're talking about and some of the IPOs that we have seen over 2025, it sort of comes back to the fact that many of these companies that are coming to market and that will come to market, that will be successful in accessing the public markets, have generally been backed by the best venture capital managers. And so I think we're going to see the power law in terms of distribution liquidity. So that we're not going to, I don't think we're anticipating like a really broad-based IPO market. I think we're going to see some very significant IPOs, but I do think that capital, in terms of once it is returned to investors, which is sort of the part of the game, is ultimately going to flow to top decile and top quartile venture capital managers. And I think what that means is that, in terms of returns and DPI, it's really going to flow to that smaller group. So I think as we think about returns, DPI, we think that power law is absolutely going to persist. It always has within venture. We think, if anything, it's going to concentrate a little bit, which goes back to kind of one of our core tenets, which is, we want to be backing, the top decile and the top quartile venture managers, because that's where you're going to be able to generate the types of returns that you need, but also be ultimately able to achieve the liquidity as well in terms of DPI. And, as companies, I think the other trend that's, which I don't think is going to reverse in the short term, is that the size and scale that's required to have a successful public offering today is only ever, it seems to be increasing. You could even say that, if you're a sub $10 billion company from a market cap perspective, it's very hard to get attention. And so, as companies that we've talked a little bit about today, companies like SpaceX and Anduril and Databricks and OpenAI and Anthropic, if they come to the market, they're going to be mega IPOs. So it's sort of a little bit hard at the same time to see, some of these smaller ones that, are they actually going to be able to gather the attention? So it's going to be a really interesting space to watch over to 2026. Certainly an anticipated from a venture investor's perspective, but the whole trend of companies staying private longer, scaling in the private markets, generating that value in the private markets to the benefit of the private market investors are sort of all themes that we think are going to continue, and if not, probably concentrate on
So on the topic of, in a world where companies stay private for longer, how are you using secondaries as a strategy to manage liquidity, diversification, and the exit strategies for the underlying companies?
Yeah. So secondaries, it's an area which is developed significantly in terms of the venture space over the last 5 years or so. And I think today, the secondaries, and particularly direct secondaries, has become a well-established tool. And I think the whole concept of companies staying private longer, their secondaries can make a lot of sense. And I think that's sort of, there's a nuance to it, right? There's this nuance of, who you're providing liquidity to, why you're providing liquidity to them. And then as an investor going in, what's sort of your time horizon and how are you thinking about the sort of the future projection of the company. So today, the secondary market for ventures is growing significantly. And, you have companies today that are staying private longer. They're also extremely scaled. And there's sort of two, we've got a class of companies which are that are basically large enough, and they could be public companies, but they're choosing to be private companies. And that's sort of a part of the market where, secondaries makes a lot of sense. The companies at the end of the day still have control over who can be on the cap table. And so that's, I think, from our perspective, one of the unique benefits of what we do is that we're able, we've got established relationships with a lot of these companies. We're also very close to sort of either board members or investors in those companies, and we are a trusted partner. One of the sort of terms is that we like to think of ourselves as a liquidity partner of choice. So I think that positions us well in the secondary market, because I do think that while direct secondaries have become more popular, there are some traps out there for investors. Some of the private companies have spoken about the fact that, they necessarily are not allowing people, you can't trade in and out of these companies, and that people should be careful about what they're doing. So I think the direct secondaries market is for venture is definitely here to stay. I think the whole concept of companies growing larger and taking longer in the private markets, staying in those private markets longer, really does provide a unique opportunity for investors like us. And I think our viewpoint is that it's sort of not a single point of time. For many of these companies, and going back, we've spoken to a couple today, that we mentioned, and you were asking about earlier, SpaceX and Anduril. Our view is that, across our platform, whether it's the direct investment part of our platform or the secondary investment part of our platform, or even our fund investing, what we're ultimately trying to do, and I think what the most effective strategy for investors is that, how do you identify what are the most important companies in the ecosystem? We try to identify those companies before it becomes kind of public, knowledge, so to speak, the ones that everyone's talking about. And during the life of that company, we're looking for ways to build our exposure, whether that be through fund investing, direct investing, or in the secondary market. And in the secondary market, that can be a combination of direct secondaries. We're also, work with some of our GPs to do GP-led secondaries, and also buying positions of LPs in funds that have some of these value-driving companies. So, I think the secondary market, is going to continue to grow. I think it's a very well-established part of the venture kind of opportunity set. But I think the way that we view it is that ultimately it's not the end game. What we're actually ultimately doing is trying to identify as early as possible what we think are going to be these most important companies. Again, power law, the reality is that, again, most of the exits, whether they be through a public market or whether they be through M&A, most of that value is going to flow to a small percentage of the overall companies within the ecosystem. Power law is going to dominate that. So for us, it's about how do we identify those companies and build positions. And I think today in the secondary market, it's a great tool for us. It's one that we've been using for a long time. And again, one of the largest players. So we're very excited by it.
The listener only remembers one thing about allocating to the US VC and PE space over the next decade, what would that be from your perspective?
Look, I think, one of the tenets that I've used across my career is that don't bet against innovation. And I think, venture is where innovation happens. It's where all these great companies are started. And if you look, you just got to look to the public markets. Today, the most valuable companies in the world are all technology companies. And they were companies that were started as venture-backed companies. And so I think that, and I don't think that's going to change going forward. Technology is the driving force for much of what's happening across the economies. It's driving growth. It's today the largest share of earnings in the public markets. We're trying to find and back what that next generation of great technology companies is going to be. Again, it may be, we're sort of seeing some of them that are going to potentially come to the market. They are going to be generational companies. These are going to be some of the most valuable companies in the world. So I think, innovation, you want to back innovation and technology. I think you need to be thinking about venture capital as part of that matrix.
Thank you for sharing the insights today, Phil. We believe StepStone is a vehicle that offers growth diversification across some of the highest private companies in the world today, and offers a structure that is flexible for investors and offers better liquidity than traditional VC funds out there. Do you have any final thoughts, final words for the audience today?
Well, firstly, thank you very much for taking the time to talk to me today and for your support. You've been great partners. And I think, we have a number of different products across our platform that suit different investors. And so I think, venture capital, is an important asset class. I think we've seen innovation in the ways at which more investors can participate. And that's not only us. I think we're seeing that broadly across the market. So we're very pleased to be able to offer different solutions for our investors. And it's been fantastic working with you guys.
Thank you.